That can of Coke that you just purchased at the grocery store, that house you just purchased, that car you purchased, we don't really know the true price. That is a fictitious price. Every day that goes on, we're getting closer and closer and closer to the next cycle. The risk parity portfolio will get crushed. But one thing I can tell you is the end game is society as a whole getting poorer.
1, you need assets. 2, they're stealing from you. 3, they're devaluing the dollar that you work so hard for.
Because it pushes people out the risk curve and it distorts the economy, it reduces the standard of living because it's reducing the amount of goods and services.
It's time to stand up, rise up, and actually put your head above the ground and realize the chaos that's ensuing in the public market, in the US dollar, and realize that you've got to actually do something. Hey gang, I just shot a powerful interview with George Gammon, who has a boiling conviction that the Fed has broken the law, and therefore, he's taking a stand, rising up, and suing the Fed. It's a powerful video that's going to stimulate your conviction as an investor of why you're investing where. If you enjoyed this video, hit the like button, subscribe to this channel, and then share your greatest takeaways in the comments below. Hey, this is the Solomon Investor Show. I am your host, Blake Templeton, and this is where we focus on the wealth strategy of the world's wisest man, King Solomon, and then translate it for you, the 21st century investor, covering everything you need to know from wealth, faith, and excellence. Today, we'll be unveiling what wealth really is from a macroeconomic standpoint. And then we're going to get an inside scoop from George Gammon himself on how he is actually suing the Federal Reserve. Today, my special guest is Mr. George Gammon himself. George started and operated multiple businesses in the convention and advertising space. He grew his last business to 24 million in annual revenues with 100 employees. And then after 12 years as a successful entrepreneur, George semi-retired at the age of 38 and shifted into real estate. So my man, now we're talking, shifted into real estate, and he now manages a multi-million-dollar real estate portfolio. What George is most known for, however, though, is his macroeconomic view. He's a master of what I would call a master of macroeconomics. He loves learning it, he loves teaching it, and he breaks complicated topics down where the average person can truly understand it. Then you'll find him interviewing the world's top experts in their respective fields on his popular YouTube channel called George Gammon. So I highly recommend you guys check out George's channel. George, welcome to the show.
Hey, thank you for having me.
Hey, man, it's my pleasure. A Solomon investor. So my listeners are coming into this because they're looking for asymmetrical opportunities. That's why they're a Solomon investor. That's why they plug into Boron Capital. You know, they're wanting upside, more upside, less downside. Right. And obviously, you know, we get these asymmetrical opportunities in our investments by having asymmetrical information. And that's obviously what most don't have. And that's why I have you on the show. I'm really interested in picking your brain. I'm really interested in helping our listeners gain a boiling point of conviction. The majority of times, we both, you and I both, we see it, that people actually get into their investments by a passive flow of like no emotion. They're just kind of tossing money at something. Right. And they don't even know why they're doing it. There's no financial literacy. So I look forward to pulling your conviction out and seeing, helping them actually drive in to realize that they have to have conviction as well. So let's start here. What is the real Federal Reserve? Like, what really is the Federal Reserve?
Well, the Federal Reserve is the central bank of the United States. It was set up in 1913, and it was there to act as the lender of last resort for the banking system. And the pitch was that it would smooth out the business cycle and it would prevent all these bank runs. It would be a lot better for the economy. What we've seen since 1913, though, is a gradual depreciation of the dollar in terms of its purchasing power relative to goods and services. In other words, consumer price inflation. Now, and also people look at the 1930s and they say, well, you had a deflationary spat during that time, but they don't realize that although that was a depression, only the very first part of it was deflationary. If you look at from 34, 35, 36, we went right back to probably maybe 3% inflation, consumer price inflation during that time frame. Then we had a lot of inflation during the 40s, 50s, and 60s. They pegged the yield curve after World War II, actually maybe even during World War II, I think. So they made real interest rates negative. But without going down that rabbit hole, what that has done is that has really hollowed out the middle class. That constant trying to create consumer price inflation, the goods, services that you buy on a daily basis going up annually, making you basically poorer. That policy has really affected the poor and middle class negatively. And most people really don't think that through as to why. I can explain.
Yeah, I think you're 100% correct. Like no one in the middle class and even upper middle class even understands that at all. So why does that make them more poor? And even more than that, why that was the pitch of why the Federal Reserve was put forth. What was kind of the means behind why they were really doing it? What was their agenda?
Well, who knows? I don't know. You can get conspiratorial and say that it was just set up by the banksters to enrich themselves. Sure. If you want to give them the benefit of the doubt, it was the earlier story that I gave you, that it was set up just to act as a backstop for the banking system, which would smooth out the business cycle and decrease the amount of boom and bust we would have. Ironically, in my opinion, they're making the boom and bust cycle a lot more extreme because they're manipulating free market capitalism. They're manipulating the price of money. And the interest, another thing people haven't really thought through, at least the people that are comment on my videos, and I kind of use that as a litmus test, is an interest rate is the price of money or the price of currency, but currency is 1/2 of every single transaction. So if you are manipulating the price of currency, you're manipulating the price of quite literally every transaction that happens with dollars in the United States and to a certain extent overseas. So there is no true price discovery. That can of Coke that you just purchased at the grocery store, that house you just purchased, that car you purchased, we don't really know the true price. That is a fictitious price. Sure, it's the price that you're paying, so that's the only price that you really care about. But what it would be in a free market, nobody knows. And that is incredibly important because the prices, the price signals, the information that we get from the prices being created by the free market, that's what we use to create efficiencies and allocate scarce resources with alternative uses. If you don't have those prices telling you what to do, then all of those resources are going to be wasted. An extreme example of that would be communist Russia. That's why it collapsed in on itself. That's why they had the Ukraine, but yet they had millions of starving people because the central planners couldn't really figure out where they needed those resources to go. They would waste them. And a big part of that was price signals. So the Fed destroys that. But going back to its very basic level, I'll give you an example that hopefully will hit home with everyone.
Sure.
So during the late 1800s, we had deflation, consumer prices going down at maybe 2 to 3% per year. Let's call it from 75 to 95, that 20-year period in the late 1800s. And let's just go back and assume that we had today's dollars and we've got your typical McDonald's worker. And let's also assume that they're making $1,500 per month and their expenses are about $1,500 a month. Well, fast forward 20 years. And by the way, during that time frame, there was 1%, roughly 1% wage increases, nominal, and there was nominal GDP growth on a per capita basis. So this person's wages go up, compounded, call it 1% per year, his nominal wages. So at the end of 20 years, they're making roughly, let's call it $1,800. So most people would say, oh my gosh, this person that's terrible. They haven't gotten a raise. They're still flipping burgers or whatever it is. And they're only making an additional $300. But what they're not paying any attention to is what happened to this individual's expenses. You see, when you take 2 or 3% compounded, as far as the price is going down over 20 years, now all of a sudden his or her expenses went from $1,500 a month. So they're just at a break even down to $800 a month. While at the same time, they went from making $1,500 to $1,800. So now there's a delta of $1,000 of purchasing power. Oh, by the way, that $1,000 buys you more than it did in year one because of the prices of the stuff that you're buying with that $1,000 going down. Now maybe assets go up. I'm just talking about consumer goods. So what the Fed did is and that's what would happen in a free market economy. It makes sense. Yeah. Why? Because an entrepreneur is going out there and creating more goods and services, and they're trying to create them more efficiently because that gives them a price edge.
Lowers the price.
That's right. That lowers the price. So they're constantly out competing with one another, trying to create efficiencies and trying to be more and more productive. The more productive a society is, the richer it is by definition.
Right.
And therefore you get prices going down. And what's ironic is that most of the people that are very, let's say, phobic of prices going down, and they have a right to be now because our whole entire system is based on debt. So in a normal free market, it wouldn't necessarily look like that. But in a now with this debt, if we have prices go down, then that could be this kind of doom loop spiral that would affect demand and therefore affect negatively nominal GDP. But what's interesting is they always say, oh, well, we need prices to increase for XYZ reason. That's a healthy economy where prices are increasing by 2% per annum. But yet the Keynesians are all demand side, right? That's all about the demand side. But ironically, one of those basic laws of economics, supply and demand, is if the price of something goes down, what happens to the demand? It goes up. It goes up.
It goes up.
If the price goes up, the demand goes down. So if you're a Keynesian and you want a lot of demand, well, you should want prices to go down. You shouldn't want prices to go up. But that's the distorted world that we live in. So that's the first thing the Fed does. And they eliminate the possibility for people to just work, save money, and to get ahead. By the way, one thing I didn't mention is during that time frame, there were the interest rates you could get in a savings account right about 4%. So you could put your money in a 4% interest yielding savings account, and your real rate of return, adjusted for inflation, would be maybe 6 or 7%. So what this does is this allows people to produce more than they consume, save the difference, and take almost zero risk by just putting their money in a savings account, but yet get rich over time because 7% compounded, when you're adding to that every year, that's a good number. That's a real good number after, let's say, call it 30 years. And then you can give that to your kids. You got all this purchasing power. That's how people really get wealthy as a society. And then, of course, when the banks are lending prudently and they're not being bailed out, and we're not creating this moral hazard, then the banks are going to lend in a way that creates even more goods and services instead of all of this consumption. But what we've done now, because of this policy of constant inflation, constantly prices going up, is it creates an environment where people can't really save and just in cash and increase their purchasing power. In fact, they'll lose purchasing power. So it builds this whole entire society where you have to become a speculator. You have to become a gambler, and it pushes you further and further and further out the risk curve. Now, unfortunately, what most people do, because to your point, they really don't give this any thought. They just know that if they have $100,000, they can't just leave it in the bank. Instinctively, they know they're going to lose purchasing power. So they've got to do something. So they listen to Dave Ramsey at the very most. That's probably the most amount of research they do, or they just talk to some of their buddies at the local football game, or where they get the UFC pay-per-view and they ask Bob what he's doing and Jim what he's doing, or Jane or Jill or whatever. And they all say, oh, well, I just went down to my financial planner and they told me just to do this portfolio as a 60-40 risk parity.
Right.
And you just, based on your age, you kind of calculate it up or down a little bit. But if stocks go up, then you've got a hedge of bonds. And if bonds go down, then you got the hedge of stocks and blah, 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 blah. This basic risk parity. And then what the financial planner will do is they'll take charts going back to like pull something out of the air, 1981. And of course, this is random because what they'll do is they'll only show you charts of the last 40-year cycle when interest rates have gone down. And they won't ever show. And then no one is smart enough, or not that they're smart enough, but they're not financially educated enough to ask that financial planner, hey, can you show me a chart of what happened with this risk parity portfolio prior to 1981 when interest rates were on an up cycle for 30 years? What happens to the portfolio then?
Right.
And then what are the probabilities? Now we're obviously long in the tooth for the last down cycle in interest rates, because it started in 81 when Volcker jacked rates up to 20%. Now we're at 0% Fed funds. So rates have gradually gone down since that time. But these cycles go back hundreds of years in the United States. And you see that interest rates, they go in these long-term cycles, call it 20 to 40 years.
Right.
And we're extended now, almost at the, at the 40-year mark now. So at some point in time, we've got to turn and go back the other direction. Now, maybe that has already happened. We've seen the 10-year and the 30-year go up to, what are we, 1.6, I'm guessing 1.7, something like that. And maybe now the tide has turned. We shall see. But at some point, every day that goes on, we're getting closer and closer and closer to the next cycle happening, in which case the risk parity portfolio will get crushed.
And I think that's the point that is the linchpin, that because of the passive ignorance, over their last 30, 40 years of investing, the ignorance of that, they don't even see that cliff coming. They hear of it, but it's intellectual hearing of it and not emotional hearing of it. And that's the key, is you've got to have this emotional conviction, a boiling point of hatred for all of the wealth that you have worked so hard for to be stole from you. You've got to have a boiling point of hatred to actually make a extreme shift, from the public market to the private market. And so I want to back up to take what you've just said and kind of summarize that on a lower level. So you've made a fantastic point, George, of essentially that free market capitalism, like how it should have been. That should be the constant that we're utilizing to see how far off we are, which would show how bad off their investments are, which means they need to do something about it. And the beautiful thing about that constant that you painted so well was you didn't have to even have as much, because everything was in your favor. The ability for economy of scale and efficiency, technology, everything on the majority of all things being produced is on a downtrend of price, because everyone is working together for the greater good to actually compete against one another to get that price down. So that meant everything that people were buying, they could buy cheaper. So you gave the analogy where the person's income didn't go up very much, but the expenses went down. And so, guys, that's how it should be. And clearly what you're seeing is everywhere is that's not the case. Your dollar's going, the dollar that you have in your pockets, it doesn't count for as much as you actually had previously. And every year you have the salary that you have will go, the value of that dollar, the strength of that money buys less.
That's right.
And so in comes the Federal Reserve to solve that problem. And the more money they print, the more that dollar is devalued. So, George, what's happened to the value of the dollar since it started?
Well, it's gone down by 97%, 95%. as far as the value. Yeah, and they're explicitly telling you that they're trying to create inflation. They're trying to make you poorer. They're coming right out and saying, we're trying to make you poorer by a minimum of 2% per year. So I mean, how anyone can take that in a good way, I don't know.
but I think what it is, it's that clearly, it's the idea that there was no other option for them, and so for those who are investing, that's the point. You've got to have a strong conviction to turn your head and question your blind spots out here, that there is another way than just investing into the stock market. Let's talk a little bit about the zombie companies. Kind of tease that out with everything the Fed's done to back up those zombie companies. And they're now over leveraged more now than they've ever been. They've got more debt now than ever. Let's tease that out. How bad are some of the companies that are publicly traded in the market?
Well, I mean, when's the last time you went to a Best Buy or something? When's the last time? I don't know if Radio Shack still exists, but they were really on life support for a long time, compliments of the low interest rates in the Fed. And corporate debt now is at an all-time high. I mean, how can that possibly be, looking at what we've dealt with globally or in 2020? As an example, we've had businesses shut down. We've had economic activity decrease substantially. You can say, well, George, GDP's up. Right, but that's because of transfer payments not even transfer payments. That's from the government just sending money to everyone. But that doesn't mean that the amount of goods and services have increased.
That's a point to note.
Yeah, they've definitely decreased. So you have to start by understanding what wealth is, which very few people do, and then kind of looking at Japan. I'm writing this down here, so hopefully I don't forget. But so most people think wealth is some number they have on their checking account. It's a number of currency units. And if society has more currency units on aggregate total, then somehow that society is wealthier. But what people have to understand first and foremost is that number, that what you think is money, is just simply a bank liability.
You got it.
So what you're saying is that if we have more bank liabilities, somehow as a society, we will be richer. Well, that doesn't really sound right. And then if you take it to another extreme, let's assume that you were on a deserted island and you had a chest full of $1 billion.
Sure.
Well, how rich would you be? You'd be dirt poor because there's no stuff. There's nothing there to buy. So this helps us understand that the true wealth in the society is measured by the amount of goods and services it can produce efficiently. Okay, well, then let's think about Japan. Now that we understand that, let's think about Japan. So they're at 250% debt to GDP, as an example, and the Bank of Japan owns about 60% of the JGBs, which is their version of Treasury. So you really only have two balance sheets involved. And you could have something called a debt jubilee, where one morning the BOJ wakes up and says, well, you know what, that, call it $5 trillion worth of debt, we're just going to go ahead and hit the delete button on that.
Sure.
And it only affects their assets and the liability of the government. So the question becomes, would anyone know? Would the man on the street buying his donut and his coffee that morning, would he even know? And the answer is most likely they wouldn't. And therefore, is this a free lunch? But the answer to that question is absolutely no. And that brings me to my point. Because the damage has been done by the Japanese government spending the money in the first place to get up to 250% debt to GDP. They have distorted the economy. They have manipulated it. They have created this misallocation of resources, malinvestment, you see? So it goes back to Hazlitt, right? And he teaches us not only to look at the seen, but also consider the unseen. So the question isn't, did Japan get a free lunch by trying to create all of this government spending that prevented their whole entire economy from crashing back in 1990 when asset prices deflated, or crashed is probably a better word. But really, you have to think through what damage did that government spending do during that whole time frame, and where would Japan be if not for that government spending? You see, and I would argue that their economy would be far stronger today if they would have allowed that malinvestment to work its way out of the system back in the early 1990s, something that we did in the United States in the early 1920s. It's the depression that most people never even knew happened. And the reason most people don't even remember it, and it's not really taught in the history books, is because it truly was a V-shaped recovery. The headline numbers were almost as bad, if not worse in some cases, than the Great Depression of the 1930s. But we were over and done with it in a year and a half or 2 years. Well, the government's response to those initial headline numbers was to do nothing. In fact, they spent less money. They tightened their belt. I believe interest rates even went up instead of down.
Very interesting.
We dealt with some pain. Don't get me wrong. There is no easy way out of this. It's just you want to take less pain now or more pain in the future through just this economic malaise and these zombie corporations that you are talking about that aren't producing really any more goods and services. Therefore, they're not making the society wealthier. They're just making society poorer, especially if your population is increasing. I know Japan's isn't. But so that's really my point. And the example I like to use is of someone that's addicted to heroin, talking about the economy and how this government spending really distorts it and whatnot. And even if they're doing quantitative easing, I mean, that's a great example right there to start with before we go to the heroin addict. Remember QE, when Bernanke first mentioned it, he didn't say, hey guys, this is QE1. He said this is QE because it wasn't supposed to be a 2, 3, 4
a brand of
infinity
method.
Right?
Yes.
But what happened is, like my buddy Schiff says, you go into a monetary roach motel and you can't get out. It's like the monetary hotel California. Once you start QE, you can't do QT. We tried that for a couple months and everything blows up. You have the taper tantrum, and Powell has to reverse course. Well, it's the same thing now with these stimulus checks and the stimulus. We're building an entire economy around stimulus and government spending. And if we look at Japan as the model, we see how this plays out. Now,
you know exactly how it plays out, right?
Yeah. Now we could have instead of an economic stagnation due to deflation, which Japan has had, I think we could have an economic stagnation, long-term recession, if you want to call it that, due to inflation. But the bottom line is it's less economic growth, and society as a whole is becoming poorer and poorer and poorer as a result of that government spending that's distorting the economy. Going back to that example I was talking about with the heroin addict, I think this is an kind of an illustration everyone can easily understand. So you've got this guy addicted to drugs. You give him a credit card, let's say, of $100,000, and he runs up that credit card, maxes it out, buying more and more heroin, making his body physically more addicted to the drug, becoming unhealthier, distorting his mind in the process. And then let's say at the end of that 100, when he maxed out the card, we come in and give that individual a quote unquote debt jubilee, right? Is this person, and where we wipe out the debt, now they have a brand new credit card with $100,000. Are they any better off?
All of a sudden, right?
Are they any better off? No, because it's
absolutely
not the debt. It's their problem. It's the fact they're addicted to drugs and their body's screwed up, right?
Yeah.
And so it's the exact same thing with the economy. Right now, we're giving it monetary heroin.
Right.
Okay, that's what the Fed has been doing. That's what the government is doing now with stimulus. Exact same thing that Japan did, created all of those zombie companies. We're doing the same thing here by bailing them out, not letting them go bust, and create this creative destruction that Schumpeter always talks about, right? We're not allowing that to happen. We're creating moral hazard which is just going to create less and less economic activity. And again, is the end game inflation or deflation? I don't know. But one thing I can tell you is the end game is society as a whole getting poorer.
Yeah. And that's the key, is the argument between inflation, deflation. I mean, it's a soap opera, and the definitions from multiple different people are different. But the key is, what's most relevant is you're getting poorer right now because of the infiltration of the money from the Fed. And that's a point that, everyone has to grab a hold of, is like when that stimulus check comes, that check is that shot of heroin. That's when right. When Biden's, investment money comes in, which is clearly not investment money, and it's going to a very terrible economic stewardship of a country. When that money comes in, it literally is just a shot of heroin. There's no more assets. You made a fantastic point that, it's about an asset base. That's what creates wealth. The number in your checking account does not create wealth. So when that money goes into the savings, or when you are buying the consuming goods and you're living at a higher position because of all the stimulus, the PPP, the the crazy unemployment numbers of what they're giving out now, that's the shot of heroin. And to your point on that heroin addict, obviously, as we know, that drug has to get stronger and stronger and stronger. And even if you give them a brand new credit card, as you were suggesting in the analogy, there's a point when the heroin, every single dose has less effect. And that's what we're finding out with the US dollar, is they're trying to get to that 2% inflation, as you mentioned, but they're printing at such a speed that they've taken down the monetary money supply one chart off the Fed, and it discontinued it because it's literally just a jet flying straight up at a vertical.
Yeah, they did that for a few different reasons. They changed things around. But I mean, really, your point is the more stimulus we do, the closer it takes the economy to its eventual death, just like the drug addict doing the heroin. And but it really starts with people understanding what wealth is. And very few people do.
Such a strong point.
If wealth was measured by the number in your bank account, then Venezuela would be the richest country on the planet Earth.
Right.
Everyone there is quite literally a trillionaire, but it's not doing them much good. I'd really ask people to do an evaluation of their life right now in the United States compared to 2019. And I would assume that a lot of your listeners or viewers own assets. Maybe they own stocks, maybe they own some Bitcoin, maybe they own some real estate. And I would imagine that the value of their portfolio, if they held on through 2020, is higher today than it was in 2019.
Sure.
So therefore, their balance sheet looks better. On paper, they're quote unquote richer. But I would challenge everyone to ask themselves, are they richer? Is their life better, or is their life worse? Do they feel richer? Are they living in a way that's richer? Let me give you an example. My portfolio is larger now. It has a bigger number than it did in 2019, but it takes me 45 minutes to get an Uber if I'm lucky. Try getting a reservation. I was just in West Palm last weekend with Ken McElroy and Jason Hartman. It took us, Hartman tried for 3 hours to try to get us a reservation at any restaurant Friday night. Couldn't do it. Fortunately, I had a buddy there that got us in at a place. But I'm sure that everyone listening has had some sort of experience like this. You can't get, the toothbrushes are all out the other day when I went to the grocery store, just none. Like, how can that be? These supply shortages. You can't, everything is difficult to do. There's a line, it seems, for everything. There's a wait. You call your local plumber. Oh, we can't see you for 3 months. We're completely backed up. And then you kind of get to the bottom of what's happening. And every single entrepreneur that's still in business that didn't get shut down by the government back in 2020, they're like, I just can't get help. I can't get workers. I can't get help. Well, why is that?
Why?
Because the government is paying people to stay home. Therefore, the producers in society are having to compete with the government for workers. And it's only going to get worse the more stimmies and if we get permanent UBI, which I think may be a reality in years to come. They're talking about it
very possible,
at the state level and the city level right now. But so think about that. Let's say now you're someone that enjoys going out to eat. You used Uber periodically. You go to the doctor, and now it's taking you 6 months to get an appointment instead of let's call it 6 days. You go down the laundry list, but yet your portfolio is bigger. Well, so what? Are you any richer? Not really, because it goes back to what we're saying, because there's fewer goods and services available to us. Therefore, as a society, these stimulus checks have made us poorer. And that's the message that I'm trying to drive home over the last 2 weeks with my videos and like every single person I'm talking to.
Yeah, it's so good, George, because you just hit another really big pillar, which is what creates those assets, what creates the velocity of the money, creating these assets, buying these assets, utilizing these assets is people. And when the Federal Reserve is giving the heroin shot to people, just like you said, the Uber driver, he is making $4,000 doing Uber part-time, maybe in, Miami or Phoenix. And he's like, wait, I can get that off of these very different new sources of Fed monies, coming through. I can actually get that without driving and putting miles on my car, which then takes out so many different opportunities for production of new assets to actually happen. We see that in so many ways. The restaurant, the employees actually aren't there, which means they're having to buy less food because less people can come in because they can't sit people. There's half the, tables are open. I'm asking the guy at Longhorn Steakhouse, I'm like, are you guys still doing the COVID 50% occupancy? He's like, no, we're fully we can have everything, but we don't have the people, we don't have the staff. And obviously the staff wasn't the real problem. Now they are the problem because of the stimulus. So
yeah, and also too, you touched on the regulation, and that's something that most people never think through. The politicians and the economists, quite frankly, don't really think it through. They always talk about how great infrastructure spending, as an example. And Keynes talked about animal spirits, but what they don't talk about are what's the environment that would incentivize those animal spirits or really
that's the quality
promote
question
those animal spirits, right?
Yeah.
And it's not just human beings. It's not Adam Smith's invisible hand, just people pursuing their own self-interest. It's that to a point. But if you stifle the entrepreneur with more and more regulations, you're going to have even fewer new businesses, therefore fewer goods and services produced. So if we're trying, see the Keynesian right now would say, listen, this government spending is good because we have a big reduction because of COVID, lockdowns, all these things. So the government has got to come in and they've got to fill the gap. Yeah, this is just basically a bridge loan until we can get back to quote unquote normal. And then the economy kicks back in, then animal spirits kick in, and then the entrepreneurs go back out. The businesses start creating stuff. The banks start lending again. And then we just kind of we dodged the economic bullet, so to speak. Right. But the problem with that is if that happens, but while at the same time you have an increase in regulations, an increase in taxes, there's not going to be the same incentive structure for entrepreneurs to go out and do those things you need them to do. Because the politicians like Biden and all these guys, even Trump did this. They like to make it seem as though all of this is under their control. Like, all we need to do is spend on a bridge somewhere, and we're just going to automatically have this multiplier effect, and it's going to stimulate the economy. But what they never tell you is they don't have any control. Sure, they can write a check or do something like that. But at the end of the day, the people that produce greater economic activity and therefore that multiplier effect are the individuals. It's not the politicians.
Right.
It's not
the free market.
planet.
Yeah.
It's the free market. It's the individuals out there that are setting up the dry cleaner, that are setting up the little gas station, that are setting up the used car dealership, that are setting up the construction company. These are the people that need to go out and take action in order.
They're being sedated by the Fed by just
and the regulations. And what the government's saying is, on one hand, they're saying, oh, we're going to have all this incredible economic growth because of the stimulus. But in order to grow, we need the individuals, the producers. So what they're doing is they're saying,
assets.
okay, let's do stimulus, but then let's kneecap the producers by increasing the regulations, increasing the taxes.
Yeah.
So therefore, all you're going to have is spending. You're not going to have any multiplier effect whatsoever. I always tell a story of when I was in Ecuador in 2014. And I was looking at property out there, and there's a beautiful coastline in Ecuador. There's a place called Salinas, which is a little bit like their version of Miami Beach there. Okay. And Guayaquil, which is the second largest city in Ecuador, is about a 2-hour drive. Now, before it was like 8 hours because all these windy roads and country roads, there wasn't a direct highway out to the coast. Well, what the government did there is they spent on infrastructure spending, something that any Keynesian would like. In fact, even a Milton Friedman might say that's a good idea to a certain extent, because they built a highway from Guayaquil out to the coast that reduced the time down to a 2-hour drive. So you could transport goods much more efficiently. And you would have all these people go out there, buy real estate that would create jobs. They would set up businesses around those new beachfront communities, and you have all of this economic growth. Unfortunately, what they did is they built the highway, they left it for about 2 years, and sure enough, you had substantial economic growth. But then what the government did is they came in and said, okay, well, now we've got this growth because of the highway. Now let's tax everyone to death. Let's create capital controls. Let's do all of these things that stifle foreign direct investment, because we want our citizens to do it, even though their citizens don't have any capital and their citizens don't have the knowledge to really create these types of businesses. So what happened? The foreigners take all their money out. They say, no, we're not paying the taxes. We're not dealing with these capital controls. Now, everything that was set up along this highway is a ghost town. There's no multiplier effect because they de-incentivized the entrepreneur to go out there and create all these business and invest their capital, their investors. So you see, it's not about just the spending, even if, let's say, the spending is done well. It's also that you have to create an environment that is conducive to entrepreneurs going out there and doing their thing and creating beneficial aspects for all of society by pursuing their own self-interest.
Yeah, it's a really good point. And that leads us to this point that, in the last years, there's been massive shifts in the Fed, and they've been operating in a way that wasn't the 1913, objectives. And they've been breaking the law, going against their regulations over the past few years, and no one's talking about it. And that's actually what's put us in this tailspin, or this, destroying velocity of the US dollar going into so many different pockets. So it's destroying the opportunity for the free market to us to actually create more assets and gain that wealth. That's what's creating this devaluation of the US dollar and actually stealing from the people. So let's talk about this. Open up our minds to how the Fed's actually breaking the law and why it's so important for us to know and have conviction on.
Well, how are they breaking the law? They can't buy corporate debt. The Fed is the lender of last resort, and there's a clause in the Federal Reserve Act that is kind of this force majeure type thing, where in case of emergency, then we can basically do anything we want. but if you look at the spirit of the Federal Reserve Act, then there is no justification whatsoever for them going out and buying junk debt with a special purpose vehicle. And so that's why I took some action with my buddy Robert Barnes to hopefully send a message that we, the people, are not going to stand for these central planners feeling as though they are behaving as though they are above the law. Because whether it's the Constitution or the Federal Reserve Act, that is set up to constrain these individuals that have been given a tremendous amount of power. And it's to protect us, society, the public, from them. And if we allow them, if we give them the power to get around the law, at some point in time, I can almost guarantee you, whether you like the guy or gal in office or you don't, they're going to use that power against you.
That's
I can
so
promise
true.
you this. And we have to remember that this country became great. One of the main reasons is because we were a country of law, rule of law, not of men. You see, and we've completely lost our way, and we have to get back to understanding that the important part about the Constitution or the Federal Reserve Act, in my opinion, is it's a lot like free speech. You see, what determines free speech, if a country really truly has free speech, it isn't if that other person or the people you don't like are agreeing with you. That's not a measurement of free speech. Free speech is when you can say whatever you want, or you allow other people to say whatever they want, even if you disagree with what they're saying. And it's the exact same thing with the Constitution. It should be what it is. And the measurement of how well it's doing its job is if it's constraining people, the individuals, even if that constraint seems counterproductive, or even if that constraint is doing something that you don't like.
From your
perspective,
matter. Yeah.
And the same thing with the Federal Reserve Act. Even if that constraint is preventing them from buying corporate debt, and everyone agrees that, okay, the Fed should come in and buy corporate debt. That's not the point.
That's not the point. Right.
The point is you can't get around the law. And if you look at the principles involved in that philosophy and you study history, it becomes blatantly apparent that I will definitely sacrifice some of the short-term pain for long-term adherence and respect for the law that constrains the central planners.
Yeah, that's so fascinating. So you're suing the Fed, and it's a powerful, ostentatious position that is really bleeds American freedom. It bleeds like conviction of actually standing for something that actually matters, where the majority are turning a blind eye, saying, I'm just poor little me. I don't have a way to influence it, so I'll just become a part of it. I'll just be absorbed into the problem. You're saying, no, wait, let's wake up, stand up, rise up, and realize that 1, you need assets. 2, they're stealing from you. 3, they're devaluing the dollar that you work so hard for. And they're putting this money in the corporate debt, which is actually giving the heroin to these zombie companies, which you've got, over 17 that can't even pay their own principal and interest in the actual publicly traded stock market that's touted as fantastic companies. It's helping that you're helping the people actually realize you've got to have conviction. You have to actually stand for something. And one way that they can stand is actually removing their money out of the public market, removing it from the publicly traded companies that are zombie companies, removing it from their bathtub of stocks that the Fed is literally pumping money into. It's devaluing their dollar, which is hurting their actual position. Tell us more, how are their decisions in the corporate debt? I know it might sound like we're kind of beating a dead horse, but how are their decisions harming the people? What are other ways it's harming the people? How does that affect us as we go down the line?
Yeah, well, we talked about them breaking the law, and we haven't sued them yet. What we're doing is we're requesting information. We're assuming they're going to tell us to pound sand. And then if so, we will use the law to go after them under something called the FOIA, Freedom of Information Act. So
right.
Whether that's a lawsuit technically or not, most people would say it is. We're basically taking the law and going after them to try to extract information. It's been successfully done in the past, but we're just taking it to an extreme, or not to an extreme, but we're taking it to a whole new level because of what they did in 2020. And to your point, almost blatantly violating the law. And we're doing that to send a message to them to stand for something, to your point. So if you don't stand for something, you'll fall for anything. And then also to create more awareness of what the Fed is doing that is detrimental. Now, so we've got to compartmentalize. Not everything they do. A lot of what they do is detrimental, but it might still be legal under the Federal Reserve Act. So I don't want to claim that every single thing they do is illegal, but almost everything they do is detrimental. And whether that's malicious, whether their intentions are good, I don't know. You'd have to ask them. But the bottom line is, because it pushes people out the risk curve and it distorts the economy, it reduces the standard of living because it's reducing the amount of goods and services. And what's happened now, you see, you've got a lot of investors that I'm sure most of their expenses are denominated in dollars.
Sure.
So this makes it very difficult because you can find a lot of things overseas that are cheap. And I like to just buy things when they're cheap and sell them when they're expensive. But
Sure.
You can only do that to a certain percentage of your portfolio because you don't want to take too much currency risk. Because if your cash flows or your assets are denominated, let's say in the Russian ruble, but your expenses are in dollars, that if the ruble goes the wrong way, then you got problems. You got big problems.
I want to before we close, I want to take us back to that conviction. So all of our Solomon investors, they're looking to grow. They're looking to have conviction in something, to stand for something. They put that flag in the ground to say, you know what? I realize the financial literacy that I had a lack of, the deficiency of, and I want that. And so through this, again, going back to the process of, beginning and initiating suing the Fed, it's a stance that positions truth in front of everyone. And so I would love to, I'd like to see, what do you expect to get out of it? What do you expect the outcomes to really be? What would you like to see changed in the suit, by the suit?
Well, ideally, I'd like to send a message to the Fed that they just can't run willy-nilly and do whatever they want without repercussions. They've got to be more cognizant of the Federal Reserve Act, because in the future, if they try to go around it again, they realize that there's going to be people out there in the general public that are going to put their foot down and hold them accountable. That would be ideal. Now, if we get there, I don't know what the probabilities are, probably pretty low. I think that we'll be able to extract some information through FOIA because it's been done in the past.
Yeah. And it does have some viable.
There's a legal precedent there.
Legal precedent. Absolutely.
Yeah, for sure. But but the main thing here is that would be an objective, but the main thing is to create awareness. Because most people don't even know what the Fed does, if they've even heard of the Fed, if they've even heard of Jerome Powell. And there's no way that they've thought through the damage the Fed has done.
Absolutely not.
And then, see, another thing too, I had a lot of Bitcoiners, when I first announced this, I had a lot of Bitcoiners kind of attack me on Twitter, like they always do, which is ironic because I'm bullish on Bitcoin and I like it as a speculation.
Sure.
I don't know, but just because I'm not maxing out my credit card buying it, they think that I'm some sort of moron or something like that, or I'm going to have fun being broke, or what's the saying? I don't know. I forgot the meme. but these where was I going with that?
Your outcome, and then how do you see this suit, the awareness? How do you see that helping the people?
Yeah, that's what I was saying. they were attacking me because they said, oh, well, you're just wasting your money. You should just buy Bitcoin instead. And you should, just buy Bitcoin. That solves all the problems. And you're just going to waste your money and other people's money in a GoFundMe campaign or whatever. And I said, listen, you're missing the point, man. It's about awareness. How many people out there are hopefully going to become aware of the Fed because of this suit or whatever we do, whatever you want to call it, this FOIA Act, Freedom of Information Act that we file against the Federal Reserve? And then how many people are going to go down the rabbit hole and stumble upon Bitcoin or gold as a result of first finding out about this crazy guy that's going after the Fed? What is that guy talking about? The Fed? He's talking about deflate. He's talking about sound money. He's talking about free market. I don't really get that. What has the Fed done? They've created inflation, 1913. Oh, well, that analogy that he used or that example with the McDonald's worker, well, that really makes sense. And then maybe they Google deflationary money and Bitcoin comes up. Sure. And all of a sudden they're like, what is this Bitcoin? Yeah, I've heard about it. All my buddies getting rich off of it, but I really haven't had time to look into it. What was it? Deflationary money? And they start going down that rabbit hole. And all of a sudden you've got someone that's been turned on to free market economics, understands Austrian economics, understands gold, understands money, understands Bitcoin as a result of the awareness that this has created. If I could get that type of domino effect, I would, regardless of what the outcome is with the Fed, I would consider that a huge, huge success.
Yeah, that's awesome. That's the catalyst, the activation, the stimulus internally in financial literacy that people need. And it's time. It's time to stand up, rise up, and actually put your head above the ground and realize the chaos that's ensuing in the public market, in the US dollar, and realize that you've got to actually do something. You've got to remove your funds out of a position that doesn't have a storehold of wealth, doesn't have a hedge of protection. You can't keep it in the US dollar. You got to put it somewhere. You got to put it in assets. Going back to your analogy in the very beginning, that just your savings account having an extra zero, doesn't mean anything if it's not actually in assets.
Yeah. People forget about this. Listen, people, if I could say one message to your viewers, it's you don't need a stimulus check. You need to stimulate your critical thinking, and you need to stimulate your education and your understanding of macroeconomics and the world around you.
Yeah, that's powerful. It's powerful. George Gammon, everybody. George, appreciate your heart, your conviction, your desire to actually turn the tide, to actually say, you know what, I actually have a flag in the ground, and I think you should too, because that's how real wealth is built. Appreciate everything you do, my man. Look forward to talking to you soon.
Awesome. Thank you for having me on.
Hey, hope you enjoyed this video. Now I just want to process with you some quality questions. So look, why do you invest where you invest? Where's your conviction? Do you have conviction now? When you see that the entire system is unhealthy, it's not free market capitalism, it's not actually without manipulation. No, it's fully manipulated. Every single thing the Fed does to kick the can down the road is devaluing the dollar. And that's your dollar. That's your money. Do you really know how bad it is? Is your head in the sand? Have you really done that 50-50-50? Worked 50 hours a week, 50 weeks a year for 50 years, and you don't really even know what your conviction is, or even if you have one. Are you passively investing? Meaning not passively investing like a passive investor, but are you passively investing with no conviction? Like, did you just give your money to a financial advisor and just hope something good happens? Look, as a Solomon investor, it's time to take a stand. It's time to have control. It's time to actually put a flag in the ground, rise up, take action, and know that you're creating exponential wealth in a position where no matter what happens in the middle of chaos, you still create wealth. So if that is somewhere that you want to be, if you want to be an insider, know what's happening, what I want you to do is pull out your cell phone and I want you to text the word Solomon to 31996. Again, text Solomon to 31996. I want you to be in my inner circle. I want to invite you into the asymmetrical opportunities we're investing into. Because I promise you, you'll be glad you did.